Hello, viewers. It's good to be back with an update on our portfolio. We've added the likes of Ujjivan, Jana, and a couple more small finance banks, and our investors are curious on why we are taking a bet on the small finance banking industry. I'm joined by Ajay. Ajay, what is exactly happening in this industry right now, and why is this industry compelling enough for us now to take a bet?
So let me kind of first address the bigger point of, is the situation very bad in micro lending or microfinance? As of today, the answer is no. But to kind of quickly take you a few quarters back, I think the microfinance stress peaked around the period of September, October, when the NPA ratios went all the way up to 11.5%. But since then, they have very steadily declined. December was around 6.5, 6.7%. February, this number came down to 5.7%. Towards the end of May, I think this number is around 4%. And in the next 3-4 months, it will go back to the industry average of sub 3% NPA ratios. So it is fair to say that the cycle has bottomed out, or it is closer to the bottom. At the same time, the new loans in the last 6 months that all these microfinance companies and small finance banks have given out, they're all at a collection efficiency of 99.5%, including the likes of Karnataka and Tamil Nadu, which are the bigger stress areas. Let me also address one of the points here. We have not added all pure play microfinance lenders. There is only one MFI NBFC, which is Fusion. Other than that, we've added Ujjivan Small Finance Bank, Jana Small Finance Bank, Suryodaya Small Finance Bank, and Bandhan Bank, which is a large universal bank. One of the points that I am going to make here is that these small finance banks have already diversified their books over the last couple of years to an extent that most of them are having a microfinance exposure of sub 40%. That is one point. The other critical point to understand is that most of these microfinance loans are now covered by various credit guarantee schemes by the government. There is CGMFU, CGTMSE, and credit guarantee for micro loans. So there are enough insurance schemes per se by the government where most of these assets are covered to the extent that 60% of the portfolio of our investee companies is covered by insurance schemes. And lastly, there is a very big opportunity here. Why? Because the government is pushing for better credit at the lower strata of the society. The RBI is working on easing credit flow. They reduced interest rates very recently by 50 basis point, and CRR cut by 100 basis point, which is a big positive for lenders. And this was clearly done to make sure that there is enough credit available across board for consumption. And at the same time, RBI has over the last 3 to 4 months also eased a couple of norms for MFIs and SFBs to lend more. While there is MFIN, which is the self regulatory body, which is focusing on improving the underwriting and credit policies. So, overall, I would want to summarize saying that look, the stress has bottomed out. These are cyclical bets. We are at the closer to or at the bottom of the down cycle, and the coming year will see improved collections, improved balance sheet quality, and each of these companies will go back to their steady average, which becomes a good investment opportunity for us.
Yeah, you mentioned that this is a cyclical bet. Uh, if we look at the post-COVID lending boom, it was mostly driven by unsecured lending. And post-COVID, when the incomes resumed, people started preferring consumption over repayment of loans. That was mostly the scenario. Um, but that led to defaults, which weren't visible there through loan restructuring, moratoriums, and many things. But those defaults surfaced in the year gone by. That is the reason we saw the earnings drop, the stocks plummet, all of it happening all together. What went wrong in the last year, and what is changing now?
Okay, so let me address it or answer it this way, that did something really go wrong? Probably the answer to that is half yes, half no. Is something changing by a wide mark? Probably no. Again, as we said in our previous remarks, that it's a cyclical industry, right? I mean, 3 or 4 years are very good for lending, and then there are 1 or 2 very bad years. If I were to quickly look at the microfinance exposure of the country, uh, towards the end of March 23, this number was around 3.3 lakh crore. In March 24, or year ending March 24, this number increased to 4.4 lakh crore, which is almost a 25% plus growth. Uh, what kind of prompted this? Probably a very strong asset quality over the last 2-3 years, support from the government and RBI, and again, very strong consumption boom. The 4.4 lakh crore quickly fell to 3.25 lakh crore towards the end of March 25, which means from March 23 to March 25, have we corrected a lot, or have we kind of seen a very sharp deterioration? The answer is no. I mean, we're talking about a drop of 1.5-2%, not much. So essentially, all the over leverage of the calendar year 24 or financial year 24 has gone out in the last 1 year. I wouldn't say it was a long term bad quality issue. It was just 1 year of over leverage where these stocks went up suddenly, the books went up suddenly, and then in 1 year the cycle turned bad and it came down to an extent that it has again, as I would say, bottomed out. If I were to also look at other numbers, there are 8 crore low income borrowers in the country, 11.5 crore loans outstanding. This part of the society is very important. Having said that, they may not have enough assets to be able to take asset-backed loans, but they have decent cash flows. And the cycle continues to play out in a way that there are good years and there are bad years. But towards that end, both the government and RBI, they know that this number of 3.5 lakh crore will stay, and this segment of the society will continue to require regular credit. The only thing is, underwriting policies will improve. They are improving, and they will improve further. Exposures will go down to an extent that when all of this bad loan situation happened in the last 1 year, MFIN, which is the SRO, came out with guardrails 1.0, which was to say that the loan exposure per borrower will be limited to 2 lakh. The lender exposure per borrower will be limited to 4. No new loans will be given out to delinquent borrowers with greater than 90-day past due or more than 3,000 rupees of dues. This further went into Guardrail 2.0, which comes into effect or which came into effect on 1st June, which said that the number of lender exposure will be further limited to 3. As we speak, there are only 3.2% borrowers who have more than 4 lender exposure. So collectively, the underwriting quality is improving, and the flow of credit remains steady. There was one bad year which is kind of past now.
Yeah, so well, that bad year gave us an opportunity to enter these stocks at a very good valuation. So yeah, that's a positive. But coming back to our point, coming back to cyclicality, the cycles have gotten more and more steep. Uh, the banks have been thinking by proxy, following the flock. If a couple banks tend to increase the proportion of their unsecured books, or most of the banks follow. So, is there something that a specific bank's management can do differently from the industry to even slightly insulate themselves from these adverse cycles? How important is the management of these banks over here? And with the banks we've added, what would you want to say about the management quality of these banks? Because these adverse cycles keep on coming, and with this following the flock mentality, it becomes more and more worse for the industry in general. So what do you think, and why do you think these banks are specifically good?
So look, I will not say that, look, these managements are very different. And ultimately, there is a level of herd mentality, right? If four large banks are going to suddenly focus on secured loans, then the other seven small banks will follow, right? Because these large banks are creating a market, they are creating processes, products, etc., that the smaller banks will only replicate. Having said that, there is some degree of difference in each of the managements. Like I would, for example, say Suryodaya was, they are small, but despite being their small size, they were one of the first small finance banks to take the credit guarantee schemes to an extent that they recently received their first claim. Bandhan Bank, on the other hand, is a very different bank. It's a universal large bank, 1.3 lakh crore of loan book, 22,000 crore of net worth. They recently received about 1,000 odd crores of credit guarantee claims. So it's a very large, well-run bank now with professional management, no promoter overhang, and all of that. Similarly, Ujjivan is different in a way that they identified stress earlier than the pack, bucketed their branches into different zones to the extent that Q4 numbers were probably the best for Ujjivan compared to the others. So there is only so much difference in the management. At the end of the day, what value would I, as an investor, put on management is to see the culture, to see the underwriting processes, to see the loan reporting, provisioning, to also understand their risk matrix. Like again, Suryodaya's example, like being the earliest to take insurance schemes. Uh, at the same time, there is, for example, Fusion, which is very different from this pack. They have seen a management change. They've got a new CEO. They recently did a rights issue where Wabag, which is an existing investor, participated heavily. So to that extent, I think management is important in kind of identifying or being ahead of the curve in identifying stress, managing that stress, over provisioning to an extent, and all this while one of the things that we've seen in most of these small finance banks, including the ones we've added in the portfolio, is that while they reduced lending because of the stress, they all focused on building a very strong liability franchise to an extent that at a portfolio level, we've seen the CASA and term deposit growth of almost 24% over the last 3 quarters, right? So management is important. The way we look at it at Piper Serica is their uh, risk management, their ability to kind of, that is where leadership shows. In worst times, they've all focused on strengthening their balance sheet, increased their CASA and deposit base to be better prepared for a brighter next 2-3 years. Uh, I would probably end it with a note that, look, each of these opportunities, while being cyclical, they are available at very good valuation. Most of the stress is already identified, provisioned. There is enough insurance that is covering some of these stressed loans. We are already at a point where the industry level NPA has come down to sub 4% from a peak of 11.5%. So I think next year or two will be a great opportunity to make money in these small finance banks.
Thank you so much, Ajay. I think we've gotten a good insight on the industry and what's happening right now. And I think our investors feel confident enough now uh, in our bet that we have taken on the industry. Uh, Thank you so much, viewers, for watching this update. If you have any questions, any queries, you can drop a comment. You should definitely check out our new website and do reach out to us if you have anything to ask. Thank you so much.